You don't need a market structure shift if you are using fair value gaps. That is exactly a tweet that I sent out recently, and a lot of people don't seem to understand what I'm trying to say. Now, the most viewed reversal pattern or the most viewed entry pattern is waiting for a market structure shift. That is the most used in SMC or even in general in the trading industry. Now, I want you to understand that this is my specialty. This is my baby because this is the basis of order flow. This is something we go very in depth on inside my mentorship. And the money making team, aka the mentorship members, exactly know what I'm talking about. I also want you to understand that this was not taught to me. The basics, a fair value gap, a market structure shift, was taught to me by ICT. So for that part, all credits to him. This manner of looking at a reversal pattern where you don't need a market structure shift. I discovered this through my own studies. Just like a lot of concepts that I'm teaching in the A to Z guide and all the concepts that I'm using in the mentorship, this was not taught to me by anyone. This was taught to me by myself. And the reason I emphasize on that is because it's very important that you can do the exact same. You can also make discoveries like this. If you just put in the work and you submit to time and you study your ass off, you need to be self-sustainable. You can't always rely on someone else, especially not if you want to be successful. So in order for us to enter without a market structure shift, let's actually look at what a market structure shift is first. Now, there are a lot of variables in the market structure shift itself, but the basic premise behind a market structure shift is when we come into a discount array, for example, that low right there, the first and most recent swing high. So that is that swing high in this case. If we trade back above that, that is exactly a market structure shift. As we talked about in the advanced market structure video as well. That is a short-term high that gets taken right there. And what does that lead to? That leads to now potentially creating an intermediate term low. If you remember 2022 ICT mentorship entry model, it is a market structure shift with displacement. Of course, I'm naming the very basics of it, but it's a market structure shift with a displacement where we need to displace above the swing high. So above that swing high, we would need to see a displacement. What is displacement defined? A displacement is a fair value gap. Fair value gap equals displacement. Displacement equals fair value gap. If you don't know the ICT 2022 mentorship model, don't worry. Now, what I'm going to be teaching you here is my own ST model. ST stands for sharp turn. My own ST model. I'm first going over the highest probability entry pattern and the highest probability reversal pattern that will suit you most likely. But I will also go over where you only need one bullish fair value gap and you don't actually need a market structure shift at all, where you can enter before a market structure shift on just one single bullish fair value gap or bearish fair value gap, only if you combine the time frames correctly. So how can we enter without needing to look at that market structure shift right there? Well, we can ignore all this to the left. The only thing I want you to do is pay attention to what's happening on the right side of your chart. The only thing relevant is that discount array. Once we trade into that discount array, the only thing relevant, so we remove everything here, the only thing relevant is if we are having bullish fair value gaps higher. If we have one bullish fair value gap higher and we trade back into a discount array, that can either be the bullish fair value gap itself or a breaker that's sitting right there. And then we have a new bullish fair value gap higher. So that's two displacements in a row. It's a mechanical order. Displacement, retracement, displacement. That exactly that is your highest probability entry pattern. What can you do after that? You can use the concepts of the previous episode to get to an entry with an overlapping PD ray. So that could be off of that breaker right there, covering that low right there and targeting the highs right there, the drawn liquidity. Now, why am I picking this in hindsight? This is all hindsight. Why are you ignoring the fact that on the weekly forecast, the free weekly forecast that I had done this Sunday, the 9th of July on YouTube, we called out this exact move, this exact sweep, and this exact move higher, aiming for those highs right there. So no, this wasn't picked out in hindsight. We called this exact move. Again, displacement, retracement, displacement. That retracement needs to be into a discount array. If you're looking, of course, to buy. And displacement, a displacement equals fair value gap equals displacement. This right here is my ST model, but that is not all. We can go even more advanced. Here we are on Euro GBP. We are coming into a daily premium array right there, ignoring everything that's on the left. The only thing relevant is that daily premium array. And then when you dive into the lower time frame, go into the lower time frame and only look at the right side of your chart. Where's your first market structure shift? Let's first mark that out. Actually, your first market structure shift is here. Where is the method we are using, the ST model? It is this right there. And then we have a new displacement lower right there. That is exactly your ST model. Now, right here, you likely wouldn't have gotten an entry. But like I just mentioned, there's a more advanced method to entering. If you combine the time frames correctly, you can enter on the first bearish fair value gap right there. That right there is exactly how you can enter without needing a market structure shift, and how we sometimes have crazy accurate entries like that. Very early entry. A little reminder, if you don't combine the time frames correctly, the best entry setup will always be when we have displacement, retracement, so right there, and then new displacement, so this entry right there. And then using the overlapping PD array or entering just off of that fair value gap, whatever you prefer. With combining the time frame, if you can manage to do that through your own study, it can lead you to not needing a market structure shift and only needing that bearish fair value gap to enter right there. This is something we go very in depth on in the mentorship. Order flow is like my baby. If you've paid close attention, you would have already seen this. But on ES, can you notice that we had the exact same entry as on Euro GBP? Right there on that fair value gap, even before we have the market structure shift. Even before we have that entry right there, we could have already been in right there. Now, how accurate is that entry for you? Is that enough? Do you need more? And it's not rocket science. It's a mechanical step-by-step guide that you have to follow. Just like everything that I'm teaching here. It's an if-then. If bullish fair value gap, enter. If displacement higher, retracement into discount array, displacement higher, enter. I'm constantly using mechanical guidelines. It's not random. It's not whatever fits my narrative. This whole move was called out beforehand using the concept that I'm teaching. Can you notice how beautifully fractal that is? Now, what is the logic with the method here, with the ST model that I'm teaching? Why an ST model over just your market structure shift? Well, the ST model, again, it is two rules combined into one. It is easier and it is stronger. And the logic behind it is, if price is ran by some sort of algorithm, by financial institutions, by banks, etc., and they have huge orders, what will happen in price? Price will displace. Price will displace. What is displacement again? A fair value gap. Price will show fair value gaps when we are coming off a premium or discount array. Price will show fair value gaps because the orders are so huge. Price will leave behind inefficiencies. So what is more important? The inefficiencies, the fair value gaps, or a market structure shift? The fair value gaps are the most important. The fair value gaps tell you the story. And the fair value gaps telling you the story is exactly what we will go over as well in the next video on Friday. It is not that market structure shift that's telling you a story. It might be a confluence, but the main story is being told by the fair value gaps, not the market structure shift. All right, USD Canadian dollar right here. Now, the line you are seeing right there is a 4-hour premium array. So why didn't I take this trade right there? Again, you need context. Everything that you're doing, you need context behind it. So as well, the reversal pattern that we're talking about here is, of course, fractal. So the same reversal pattern can be applied on the higher time frame. The ST model is not only for your low time frame, it is as well suitable for the higher time frame. It can lead to your bias. The ST model can lead to your bias. We wait for that premium array right there to be tapped into. We tap into it right there. Now, again, ignoring everything that is to the left. The only thing we need to see is a bearish fair value gap. Right there, we have a potential bearish fair value gap. There it is, confirmed. So what you would now do is you would scout your market execution on your other screen or wherever you have it, on your phone maybe, wherever your market execution is ready to execute when we come into that fair value gap. All right, we don't trade back into it, but we have a new fair value gap to work with. So you would enter on this fair value gap right there. Market execution ready to execute on that fair value gap. We sting into that fair value gap. Where's your stop loss? Above the potential intermediate term high. Targeting the future drawn liquidity right there. And that is my ST model. And you can notice right here, where was your market structure shift? Your market structure shift was right there. Again, if you like this and this already blows your mind, then come see what we have in store for you inside the mentorship, because that will truly blow your mind. How we are able to use this, how we have already racked up 950K assets under management in 4 months. 4 months of the mentorship being live. And I don't want to take full credit for that, because it is my students, it is you, it is everyone that is watching, that is putting their trust in me and that is working their ass off. So it's not me, it's you that's making it work. So thank you for that. I owe you a thank you. Thank you. Thank you for your support. Thank you for your trust. This is only the beginning of order flow that you're seeing right here. Now, if you like using the market structure shift, then please go ahead and use it. But I believe you are doing yourself a disservice by not using the ST model. It makes life so much easier, way more accurate, higher probability. What more do you want? Next, on Friday, we have the topic how fair value gaps tell a story, going even more in depth. But if you want more advanced insights, again, the mentorship is the place to be. Perfect. Thank you.